Hello friends, our next topic is piecemeal distribution. Piecemeal distribution is concerned with partnership firms. It is distribution of cash among the liabilities of a partnership firm at the time of dissolution. So as we all know, when the firm is dissolved, the partners should pay for their liabilities either from assets realized or from their own property, because the liability of partners is unlimited. So whatever way they follow, they should settle the liabilities first, and then if cash is available, then partners can get back their capital amount. So basically piecemeal distribution is distribution of cash among various internal and external liabilities of a partnership firm at the time of its dissolution. So first part is partners need to sell the assets and realize the cash, and second part is there should be proper distribution of the cash among various liabilities. So at the end, if there is surplus cash, this cash is profit on realization, which is shared by partners as per their ratio. Similarly, if there is shortage of cash, it is loss on account of realization. Again, sharing should be same. There must be a sequence which is to be followed at the time of settlement of liabilities. First of all, the partners should pay for the realization or dissolution expense. Without payment of these expenses, they cannot get the asset realized, they cannot get the cash. So basically they have to pay for realization expenses naturally. Next, after realization expense, they have to pay for government dues or legal dues. If there is some penalty on partnership firm or tax payment is outstanding, they have to pay for all government or legal liabilities. After that, they need to pay for secured loan or term loan taken from bank against particular security. So this secured loan should be a loan which is secured against particular asset held by the partnership firm. And next part is unsecured loan, the loan which is taken without providing any security. But here it is not only loan, there are certain liabilities also, because normally creditors, outstanding expense, bills payable, these are considered as unsecured liabilities. So all these liabilities should be settled after secured loan. Second last is loan from partners. If the firm has taken some loan from its partners, that should be settled after outside liabilities. Here the loan from partners is no doubt it is a liability of the firm, but it is internal liability. And last is partners capital. If cash is available after payment of all other liabilities, then only partners can get back their money. But while making payment to the partners, there is a problem of the capital contribution being not in their profit sharing ratio. So we need to deal with this problem in piecemeal distribution. So for payment to partners, there are two methods in piecemeal distribution, from which as per our syllabus we are going to study excess capital method only. This method is also called as highest relative capital method. Here we need to calculate proportionately extra amount contributed by any of the partner. Here proportionately means when the profit sharing ratios are defined and still some partner has contributed more amount as compared to other partners, this more excess amount is called as highest relative capital. The capital amount which is more as compared to contribution of other partners. So while making payment to the partners, first of all we should settle the proportionately higher amount contributed by some partner, and then we need to pay for all the partners. So let's see how to calculate this excess capital. This format is used for calculation of excess capital. The names are, first is capital balance. We need to add all types of reserves of the partnership firm. It is ultimately transferred to partners capital account, so we need to add all the reserves. If there is any fictitious asset, it should be deducted. We will get adjusted capital. After getting adjusted capital, next part is calculation of unit value. Unit value is the amount contributed by partner for one share or one part in the profit. It is called as unit value. Then next is proportionate capital. Proportionate capital is the expected amount of capital which is to be contributed by the partner on the basis of the minimum unit value among all the partners. So it is minimum required of capital which is to be contributed by each partner as compared to their lowest unit value, and comparing this we will get excess capital of one or more partners. Let's see one problem. We are assuming that capital balance of ABC is 90,000, 60,000 and 50,000. Reserves are to be allocated as per their profit sharing ratio. For this question we are assuming that profit sharing ratio is 2:1:1. So 20,000, 10,000 and 10,000 is distributed among ABC. There are no fictitious assets, so adjusted capital is 110, 70 and 60. Now if we compare amount of contribution, A has contributed highest amount. On the other side, A is also getting 2 shares in the profit. So in calculation of excess capital, we are not concerned with highest amount. We are concerned with highest proportionate amount. So even if A has contributed highest amount, it may not be the highest relative contribution. So let's find out how to calculate the highest relative contribution. After dividing adjusted capital by profit sharing ratio 2:1:1, we will get 55,000 unit value of A, 70,000 of B and 60,000 of C. These amounts indicate that the amount contributed by each partner towards one part or one share in the profit. As B is getting 2 shares in the profit and amount of contribution is 1,10,000, he has given 55,000 for one part in the profit. B has given 70,000 and he is getting one share in the profit. So his contribution towards one share is 70,000 and that of C is 60,000. Next part is proportionate capital. Proportionate capital is calculated by multiplying the lowest unit value by PSR of each partner. As we can see, 55,000 is lowest among all unit values. So we need to multiply 55,000 by profit sharing ratio of each partner. So first for A, 55,000 into 2, it gives 1,10,000. For B, 55,000 into 1, it gives 55, and again for C, 55,000 into 1, 55,000. So proportionately, A was supposed to contribute 110, B and C were supposed to contribute 55,000 if we compare the ratio of profit sharing among the partners. Next is proportionate excess. It is calculated by deducting the proportionate capital by adjusted capital. That means actual contribution less required contribution is equal to proportionate capital. For A, his actual adjusted capital is 110, and comparing the unit values, he was supposed to contribute 110. So there is no excess contribution by A, it's nil. Capital of B was 70,000, but as compared to unit value, he need to contribute 55,000 only. So he has contributed 15,000 in excess of whatever is required. And same for C, 60 minus 55. He has contributed 5,000 in excess of the unit values. So in first step, it is clear that A has not contributed anything more proportionately, but step B is to find C out has contributed the excess capital some amount in excess B of and C. Steps are same. Divide by profit sharing ratio of B and C. It is 1:1 among B and C. So unit value here now is 15,000 for B, 5,000 for C. Minimum unit value among B and C is 5,000. So multiply 5,000 by 1 and 5,000 by 1 again for B and C. It gives proportionate capital of 5,000 again. Now last step is calculate excess capital. Proportionate excess was 15,000 less proportionate capital is 5,000. It gives 10,000 for B and nil for C. So this is called as ultimate excess, because B has contributed proportionately more capital than A and C. So while making any payment to partners towards capital, first of all we need to pay rupees 10,000 to B. After that we need to pay rupees 5,000 each for B and C. It is second last line of the statement, proportionate capital. And after settlement of B and C, final step is payment to A, B and C as per their profit sharing ratios. So ultimate cash available should be distributed among A, B, C as per their profit sharing ratio. So this is statement of excess capital, where we get the amount which is to be contributed, which is to be paid to each partner after making payment of outside liabilities.